So in 3.3, we're talking about credit cards. And we had actually previewed this a little bit in 3.1, right? We had talked about in 3.1 that this is, well, it's a revolving line of credit, right? We don't have a specified balance that we're trying to pay off. We just have an amount that we are allowed to spend. This is a form of unsecured debt because we don't have any sort of collateral, right? There's no sort of item that can be taken away from us if we don't make payments, but the companies will still find a way to get their money. And this is variable, these types of accounts, rather, have variable interest rates, which isn't necessarily a bad thing. They may lower your APR if you're a responsible credit card holder, but they will also raise your APR if you fall behind on payments. They may raise their APR just because of the way the market is going. But it's not always a bad thing to have variable interest. It can just be tricky to prepare for. So what is a credit card? Well, a credit card allows its holder to make purchases now and pay for them later. That's the simplest explanation I think I can come up with for what a credit card is. But it can also be a very concerning definition. There's something about this ability to make purchases now, this highlighter does not work, and pay for them later that can be challenging and can be really straining on your ability to be responsible. I'll let you speculate why that might be and reflect on that on your own. I'm not going to give it away. But there is something about being able to buy something now and pay for it later that A, is attractive and B, is challenging. As I just said before, the issuer of the card, right, that's usually a company like Visa or Discover or MasterCard, links the card to a revolving line of credit with a specified credit limit. This credit limit is based on your credit application. So just like we talked about in 3.1, the issuer of the card is going to look at your credit application to determine, well, how much do I think that they are responsible of taking on and paying back? So for student credit cards where you have a thinner file, you have less credit built up, and you also don't have an income really at that point, right? If you're a college student, you might have a lower balance. Once you get more established, I'll call it like a regular credit card, maybe you have something that's a little bit higher because you've shown A, that you're responsible, but you also have a job and you have an income coming in that you can use to pay back the credit card. The general rule and kind of the big rule here, I'll come back to that last point in a minute, but really the big rule here, and the rule with all loans really, is don't spend more than you can afford to repay. Right? If I don't have $10,000 to pay back eventually, I should not be spending $10,000 on my credit card. It's not as simple of a principle as it is, but on paper, it's a pretty simple principle. What complicates this would be impulse buying, and we've all done this before, and this is when you buy something that all of a sudden you are attracted to buying, and you never had any intention of buying it in the first place, but you buy it anyway. This could be anything, right? This could be, I don't know why I just swiped over, right? You walk through the mall, you see a pair of shoes, you just got a big promotion, you just got into college, and you go and treat yourself. It's an impulse. It's something that you didn't intend to buy, but here you are, and you bought the thing, and now you have it. And this can really complicate responsible credit card usage. Responsible credit usage. Because it can drive up your balance if you're not prepared for it. The thing that can also kind of complicate things is you're not feeling the effects of handing over the money, right? It's no different than when we talked about with a debit card, right? If here's your purchase and your purchase comes to, I don't know, we'll call it $100.50. So you take your debit card and you swipe your debit card to make that purchase, and the purchase goes through, and it's great. And, well, you don't feel the effects of making that purchase because, well, I swiped this piece of plastic, and it dinged, and I was good, and it's great, and I moved on, and I got the item. Versus if I actually, used a $100 bill and some change in order to make this purchase, the purchase will still go through. It'll still be fine. But this is going to be significantly harder. There's something psychologically, and we'll talk about this in class if I remember. There's something psychologically about handing over the hard-earned money that you worked to receive or you pulled out of the account. You have something physical and you're physically getting rid of it. It actually makes it harder to pay with cash than it does with a card. And the same thing is true. That's a terrible color for this background. The same thing is true whether it's a debit card or whether it's a credit card. In fact, it's even easier with a credit card because the money's not even coming out of your account right away. So there's something psychologically about impulse buying, and there's something psychologically about paying with card versus paying with cash. And I think in a lot of ways, paying with a card is going to make it even easier to impulse buy. It kind of enables impulse buying in a lot of ways. So we have to be careful. Well, there are two main types of credit cards. You have a revolving charge account, and this is kind of just your standard. When we talk about a credit card, this is what we think about. This is kind of your standard issue credit card. This is the one that we're the most used to, the one that we're familiar with. There's some kind of predetermined credit limit, so maybe you have like a $10,000 limit. You are not required to pay the balance in full, but you should, because interest gets charged on the remaining balance each month, and we'll talk about that actually a little bit in, I believe, the next section. But there's some sort of a minimum payment, right? You're not required to pay the balance in full. There's some kind of minimum. Like I said, we'll see in the next section why this minimum isn't great. Visa and MasterCard, right? These are two of the big ones. We also have Discover, but standard issue credit card, right? If you see these logos, if the card is backed by these big credit card issuers, then you can use them just about anywhere. Even store credit cards, right? If you see a store credit card and your store credit card has the MasterCard logo on the bottom, then great, you can use this Kohl's card anywhere. If it doesn't, if it's not backed by one of these, then you can't use it anywhere, right? I can't walk into like GameStop and use my Kohl's credit card. It just doesn't work that way. But store credit cards do sometimes partner with these companies. Kohl's is not one of them, actually. I know LL Bean is, but I don't know of any others offhand. Otherwise, they can only be used at that specific store, and that would be Kohl's. I know for a fact that Kohl's can only be used at Kohl's. Charge cards are less widely accepted usually. They're also less common now. But a traditional charge card typically requires the cardholder to pay the balance in full at the end of the month. So here's your big difference, right? You have to pay the balance in full with a charge card. You are not required to do that with like your normal charge account, revolving charge account. As a result, right, if you have to pay the whole thing off every month, there's no interest rate, which on the surface is a good thing. But there's usually a big annual fee to make up for it because these issuers are businesses and businesses want to make money. So, well, then what's going to happen if you don't make payments on the account, right? It's not just free money. Well, there's usually some kind of a freeze on the account or some kind of a late fee, right? If your account is frozen, you can't use the card. And if there's a late fee, it's just more that you have to pay. This requires a lot more budgeting or a lot more awareness in how you're spending. American Express typically offers a lot of charge cards. There's also something called Diners Club, which is not nearly as popular as it used to be, but it is another form of charge card. And it's actually why, if you notice, a lot of places don't accept American Express, and that's because a lot of times they're charge cards. And it's risky to these stores and to American Express to have these charge cards where you have to pay the balance in full, especially if you think back to something like this sloppy diagram that I put together. And if you think about impulse buying, It can be really easy to rack up a balance and then go, oh crap, I can't pay this back. So two main different types of credit cards, both with their pros and cons. And that's kind of our starter way of talking about credit cards.